You sort of triggered one thing I wanted to mention right off the bat in your preamble here, where you referred to the labor market not being as strong as it appears on the surface. And we're just coming off of another payroll employment report that surprised on the upside yet again. And yet the household survey continues to send a totally different signal. In fact, this last month, the payroll number was up 227. The household survey declined even more, down 355. Over the last 12 months, the payroll survey shows an increase in jobs of 2.3 million. The household survey shows a decline in jobs of 700,000. So you have a 3 million job disagreement between the household survey and the payroll survey. And at turning points in the economy, as you and I have talked about many times in prior conversations, household survey tends to be the better indicator. So again, this divergence is not only ongoing and, persisted for a while, but it's reached a magnitude we've never, ever seen before. That 3 million divergence we only saw for a nanosecond during COVID when, the data wasn't able to keep up with the way things were shifting on this in reality. So that just by way of saying that in terms of my broad economic outlook, my sense is that we are or have been in recession. And almost every indicator that you look at suggests we're in recession, with the exception of real GDP. I mean, you could go through any number of things. Obviously, the household survey I just talked about, the drop in full-time employment, which is down over 1 million jobs. Whenever you're losing full-time jobs, you've generally been in a recession. When you look at things like consumer confidence and sentiment, they're bouncing back, but they are still at and, mired in really recession territory. Real retail sales that have actually declined for 2 years now in terms of unit purchases. People aren't spending money because they want to. They're paying more for the same items or even less. The credit card delinquency rates, auto delinquency rates, corporate bankruptcy filings, all of those indicators suggest we're not just in recession, but we're in a severe recession. It's almost everything you look at suggests the economy is really weak, with the exception of real GDP. And real GDP, to believe that number, you have to be willing to believe the government's imputation of what inflation is. Obviously, they're deflating it by, a 2% type of number. And I think most of us and most your audience probably would agree that inflation is running a lot hotter than that. And if you believe that, then you're talking about, even if it's running 3%, you're taking that GDP number down a lot. You're cutting it in half. I went back and looked at nominal GDP, which includes both the real and the prices. And I think that's easier to measure. Think about, if you're running a business, how much money you have coming in. It's very easy to count how much money is in the register at the end of each day, rather than, in this case, the government is basically counting units and then trying to impute some prices for each of those units. So nominal GDP is right on the cusp of a recession in terms of where it is right now. I know it sounds ridiculous to say, but at 5% nominal, we're actually on the cusp of what had been recession territory before. And if you look at the forthcoming estimates for where growth is going to go, most people see growth kind of decelerating a little bit over the next few quarters. Then we'll probably be in recession territory by that measure anyway. So this is all long-winded and kind of wonky way of saying, I think the economy presently is far weaker than people perceive it to be. And by people, I mean Wall Street and investors, not Main Street, who are living this reality. And that gets us into valuations and my outlook for the financial markets. You and I have been talking for longer than I care to admit about how extended valuations have been. And now we're in an environment where the anticipation of Trump 2.0 has basically mooted all of the negative data we're seeing, because people are saying, okay, yeah, that may look bad now, but on January 21st, we're going to flip a light switch and all of a sudden, all this bad news is going to be in the rear view mirror. We need to buckle up because this economy is really going to take off. And I'll confess to having a weakness for that argument, just because I'm still nursing the scars of 2016 when Trump won the first time. This was, people forget, but in 2015, we had one of the worst corporate credit cycles since the global financial crisis. It was really kind of a lagged fallout from the energy bubble bust in 2013-14 that followed the taper tantrum. But anyway, you had a real bloodbath basically in the corporate credit market. They were laying people off. That's what companies do when they're struggling with debt service and their profits are underwater. The first thing they do is cut headcounts. So back in late 2015, early 2016, I was thinking we're headed for a recession. And I held on to that forecast even after Trump was elected, because I thought it's going to take him a while to implement these policies. And in the meantime, these oppressive interest rates are going to continue to exert a real tax on the corporate sector. He put through the corporate tax cuts and the deregulation, and the economy turned on a dime. So I get it, and I know why Wall Street is anticipating a repeat of that. But obviously, the backdrop today is markedly different from 2016, and the valuations I view as being the most conspicuous difference between now and then, particularly in the corporate credit side, where now spreads are about as low as they have ever been in history. And back then, they were hitting new highs. So that, and obviously the stock market has tremendous amount of froth in it too. And there are any number of examples of that. But so my sense is, loath as I am to bet against this economy doing a U-turn on Trump's pro-business policies, which I think will be hugely bullish, in the long run, I think getting from here to there is going to be not nearly as seamless or easy as the markets are anticipating. I think if you anticipate that the pro-growth policies are going to be stimulative to growth, and we're already in a situation where the inflation numbers are heating back up, you are talking about an environment where interest rates can be higher for longer. And that is a massive headwind to the economy broadly, but the corporate sector in particular. And what's happened is basically since 6 months into the Fed rate hike cycle, literally, October of 2022, they were basically halfway through the tightening, the markets said, all right, now we're going to start to anticipate when the rate cuts are coming, because we've seen this show before. We know the Fed is going to capitulate and they'll reverse. And so the last half of the Fed tightening was completely ignored by the markets as they began to price in this pivot. And in so doing, the entire corporate sector basically structured its borrowing on the assumption that rates were going to be lower a year or a year and a half from then. So flash forward, and now we're really taking a lot of the expected easing out of the market. And that's now before we start to see, in my view, the inflation numbers heat up even more. And then the markets will probably be a little panicked about, okay, well, that means, we're going to get less Fed easing. And what does that mean? They'll start to do the math on what it means for these corporations that are really struggling with debt service, who have been playing these kind of extend and pretend games and doing PIK issuance and this and that just to get from here to there. So I think the number one thing that I would focus on is, if you believe that Trump's going to be successful in getting these policies through, then you have to start thinking about what higher for longer means for your investments and what sectors are going to do well and which are going to suffer in that kind of environment. The second thing, I kind of think of this a little bit like the EV mandates, where let's just assume this is a worthy goal and that eventually we want to have an economy where production of critical things, is here in the US rather than overseas. And we have energy is entirely here. All the pharmaceuticals are produced here. We have legal workers doing the work rather than their wages being pulled down by illegal immigrants who are getting paid, off the books at fractions of what people who are citizens are being paid. Even if all those things are worthy goals, and I think they are, just like the EV mandates, you have to have that transition from here to there. You don't flip a light switch and say, right, all right, tomorrow, everybody, who's illegal is gone, and suddenly miraculously wages go up a lot and corporate profits will be fine. No, I mean, this is the number one cost of business. So there are going to be dislocations. I think people may recognize that in the abstract, but it doesn't appear to me right now that the markets are being very discerning about how it's really going to flesh out. And then one final comment, and this is, probably not super worthwhile, but Doge, there's a tremendous amount of excitement, and I am among those people about what might be accomplished in terms of just slashing the bureaucracy, because I think the regulations are really the thing that strangle entrepreneurial endeavors more than anything else. The thing is that when you think about the 3 million federal workers, I mean, just facetiously, I will say these people have spent their careers in Washington. They are eminently unqualified to do any kind of other work, right? Like, let's just say, I mean, that's a little sarcastic, but what are these people going to do? Let's say we could cut out 1.5 million people. What's going to happen is we're going to go from paying their salaries to subsidizing them via social supports, unemployment claims, whatever, until they're able to find some private sector employer who actually wants some bureaucrat shoveling who's done nothing but shuffle papers from their bathtubs, it turns out. There's a story about, I forget where this guy was, EPA or something, who was, they're all working remotely, and this guy posted a video of him doing his work from the bathtub. So I don't know how many private employers can be really eager to grab onto this source of labor. So anyway, that's just a small and silly example, but it's just not going to be that easy to get a lot of this stuff done, to say nothing of the bigger budget cuts. Like, already the Republicans are saying, no, we want to increase military spending. So there's already resistance, and it's even within the ranks that should be, you would think, supportive. I'm sure you saw Trump's tweet about the BRICS and their dollar diversification efforts, and the idea that if they continue to do that, they'll be subject to 100% tariff. So that was a real shot across the bow, I think, to gold bulls, since that's what they've been running to when they've been diversifying out of dollars. But again, this is another one where, the reality is going to be a lot harder to accomplish than the tweet suggests. I would argue that Trump in that tweet is dealing with the symptoms rather than the disease. If he wants them to stop diversifying out of the dollar, obviously he has to make the dollar that they're running from as good as the gold they're running to. And slapping them with 100% tariff does nothing to restore confidence in the dollar. Quite the contrary. I think it amplifies this notion of the US as a bully that helped ignite gold in terms of, when we weaponized the dollar by freezing Russia's reserve assets, that really put the rest of the world on notice that, hey, they might do this to us, so we better quickly diversify and not hold all of our assets in dollars. So, this tariff threat just really amplifies that sort of weaponization, and I would think just strengthens the view on the part of these BRICS countries that they really do want to get out of the dollar. Now, maybe they'll be a little more quiet about it. China and Russia were out there every day talking about, well, we got to, get out of this dollar. We need to come, to some alternative arrangement. And we're kind of thumbing their nose at the Biden administration with all of this. Maybe now they'll be a little more quiet about it, but I don't think it's going to change the long-term shift. I'm not really sure that threat is going to have the desired result. The other tariff threat he's made so far have already begun to generate the response he wanted. This one, I think, is going to be a little more tricky. And frankly, they don't even need to create their own currency. They could just continue doing what they're doing, and that will be enough for them in terms of diversifying out of dollars. They're just not recycling money back into our treasury market. I mean, China stopped buying treasuries a long time ago. Russia, obviously, they're now just finding other uses for these dollars. I don't know what's going to change about that. If you look at the emerging markets relative to developed markets, they're at record lows. I mean, they've never been cheaper, or put differently, developed markets have never been more expensive than they are. And, I think about these big secular themes like the end of globalization, but it's important if you believe that we're kind of at the bookend of globalization that was first launched under Reagan in the early 80s, then you're talking about a total shift in the investment backdrop from everything investors have been used to for their entire careers. Basically all of us who are investing right now, this is all we've ever known, is what I would describe as the great moderation, which is this kind of nirvana where interest rates and inflation have just steadily gone lower and lower. So the cost of capital was lower. Money that was freed up from the economy by lower inflation was able to flow freely into financial markets. So you had this kind of decrease in the demands for money in the economy, even as the economy was growing, and this massive excess liquidity that was free suddenly to flow into financial assets. And this created a whole, basically, economy that is geared to the financial markets now. At the same time, in emerging economies, they're still there making real stuff, doing real things. And we're here basically shuffling paper around in the digital universe. Now, I'm obviously grossly oversimplifying this stuff, but at the end of the day, if you think we're at the end of globalization and everyone's going to turn inward and try to live off the fat of the land, as it were, in their own borders, that's going to require some real work here. Whereas in the EM, that's what they're doing. They're already living that world. We're going to have a massive adjustment here. So, and as relates to, the idea of their obligations in dollars and their difficulty in servicing dollar denominated debt as the dollar goes up. Well, that's true. But here again, you can't paint all these economies with one brush. In aggregate, the emerging markets are the net creditor nations to the rest of the world. Mm-hmm. So yes, there are certainly those economies that are massive debtors and have way too many of those debts denominated in dollars. But in aggregate, we're the debtors, they're the creditors. So I, again, come back to Grant on that side of the argument, but time will tell.